We are witnessing the great fracture. The tech monopoly era is ending, and the physical economy is taking over.
Welcome to the XFO Intelligence Podcast channel, Market Pulse series. Today, we're diving into a seismic shift in global markets. The Great Fracture, why the tech monopoly era is ending and the physical economy is taking over. For nearly a decade, mega-cap tech and AI promised unlimited growth. That era has now ended. Over the past week, we've seen a historic structural rotation. The market is rewiring itself, driven by AI's human capital bottlenecks, a fading geopolitical risk premium, and the growing divide between digital and physical economies. Institutional capital is now fleeing high multiple tech and shifting toward hard assets, defensives, and corporate credit. Let's explore the key forces driving this transformation and the strategic playbook for the next 90 days. First, the AI illusion has shattered. The catalyst? It wasn't a table earnings miss. It was a human capital crisis. Alphabet's market cap fell by $269 billion in a day after Nobel laureate John Jumper and top researchers left DeepMind. The market realized that AI's real bottleneck isn't just compute power or GPUs, it's elite talent. Semiconductors took a hit, with the SOX index plunging 9%. The so-called Magnificent Seven tech giants have lost momentum, erasing nearly $1 trillion in value. Capital is flowing into the forgotten 493 of the S&P 500. Next, there's a fascinating decoupling between the digital and physical economies. Digital assets are dropping, while the physical industrial economy is booming. US-Iran peace talks have cut the geopolitical risk premium. Oil prices dropped 4%. Gold corrected 3%, but silver surged over 6.4%, and copper rose more than 3.5%. These metals underpin the physical infrastructure for data centers and electrification. Asian markets show the same pattern. The Hang Seng Tech Index plunged, with Alibaba, Tencent, and Xiaomi all dropping heavily, while HSBC hit record highs. Investors are rotating into high-dividend financials. Beyond macro trends, corporate valuations are being stress-tested. SpaceX, post-IPO, shed $400 billion in equity value, but it's now tapping private credit markets for $20 billion. Coca-Cola faces a $20 billion IRS tax dispute that could end global tax arbitrage. Waymo recalled 3,900 robotaxis due to failing software, proving that AI edge cases are exponentially harder to solve. The outlook for the next 90 days? The market's becoming an archipelago. In July, Q2 earnings will expose AI's ROI gap, triggering a temporary sell-off in growth stocks. August will bring the Coca-Cola tax ruling, pushing capital out of multinationals and into domestic physical assets. September will break the AI supremacy narrative. Institutional investors will pile into nuclear, water infrastructure, and space economy debt. But beware of hidden risks. There's a 68% chance of contagion overreach. When tech sells off, good physical companies might get unfairly hit. There's also a 14% tail risk of a credit bridge collapse. If corporate credit freezes, even safe, defensive assets could crash. Space credit markets, like SpaceX bonds, are thinly traded, posing liquidity risks. So how should investors position themselves? First, execute the physical-digital nexus rotation. Move capital out of cap-weighted tech and into physical infrastructure. Uranium miners, copper producers, water utilities. Exploit the July mispricing. Set buy orders on high-quality industrials at 10 to 15% discounts. Hedge the credit bridge with put options on high-yield credit ETFs and hold short-term T-bills. Finally, demand a liquidity premium of at least 150 to 200 basis points in frontier credit, like space economy debt. In conclusion, the tech monopoly era is ending. The future belongs to the physical economy. By recognizing talent as the true AI moat and reallocating to real-world infrastructure, investors can thrive in the new market landscape. Thanks for tuning in to Market Pulse. If you found this analysis valuable, we'd love your support. Like, share, and subscribe to the channel. For feedback or to request more info about our new Thought Leadership on Demand service, email us at xfointelligence@gmail.com. And remember, all information in this podcast is for informational purposes only, not specific investment advice. See you next time on Market Pulse.